In 1929, Joseph Kennedy made three specific trades 6 months before the crash. For Kennedy, a man who had already tasted the bitter and sweet sides of life in the markets, it wasn't just about making money, it was about surviving the inevitable storm that he saw on the horizon. Kennedy had been active in the stock market for years, gaining fame and fortune through stock pools, manipulating stocks by driving prices upward so that insiders could cash out before the inevitable fall. He was no stranger to risk. He had danced with danger more than once. But in 1929, he saw a pattern emerging that others were too blinded by the euphoria to notice. The market, in all its fervor, was dangerously close to the edge, teetering on the brink of collapse. The signs were unmistakable. There was an undeniable air of excess, and valuations had reached absurd levels. The Roaring Twenties had been a time of wild speculation. The market had tripled in just 5 years, and investors, fueled by optimism, were borrowing money at record levels to buy even more stocks. It was a recipe for disaster. When everyone is leveraged, there are no buyers left to keep prices up once the market starts to falter. Kennedy, with his sharp intuition and decades of experience, knew what was coming. He had seen the same story play out before, even if it had been under different circumstances. Kennedy had a choice. He could ride the wave along with everyone else and hope it continued, or he could prepare for the inevitable crash that he knew was coming. Kennedy knew that when the bubble bursts, the collapse would be swift and violent. He also knew that those who saw the signs and acted early would be the ones who not only survived, but thrived. So he made his move. He began liquidating his positions, converting them into cash. The first of his 3 trades had begun: cash. As the market continued its upward march, Kennedy quietly moved into the background, watching. But as much as he understood the importance of cash in turbulent times, he also knew that holding cash wasn't enough. Cash, while important, was vulnerable to inflation. If the market collapsed, and if the government resorted to drastic measures like printing more money, cash would lose its value. So Kennedy made his second trade: gold. Gold had been a store of value for centuries. It had withstood the test of time and had always been seen as a hedge against financial collapse. In a world where currencies could be devalued at will, gold would stand as a beacon of stability. Kennedy wasn't just preparing for a crash, he was ensuring his wealth would endure when others lost everything. He bought gold, knowing that it would protect him when everything else began to crumble. The crash, when it finally came, hit with a force few were prepared for. On October 24, 1929, Black Thursday, the market began its steep descent. The Dow Jones lost more than 12% of its value in a single day, and panic set in. By the time the dust settled, the market had lost nearly 89% of its value. The Great Depression had begun, and millions were left financially ruined. But Kennedy had already made his move. He wasn't in the streets with the rest of the panicked investors. He was sitting in cash, gold in hand, watching as the market fell. And as the market bottomed out, Kennedy pounced. With his wealth intact, he was able to pick up distressed assets at fire sale prices. He had made his third trade. He positioned for volatility. He didn't just sit on the sidelines. He used the crash as an opportunity to grow his wealth. While others watched in horror, Kennedy was making deals, buying low, and waiting for the recovery. Kennedy's foresight had paid off. While everyone else lost everything, he made $50 million. He had executed the perfect sequence of trades at precisely the right time. His wealth not only survived the storm, it thrived in the aftermath. Fast forward to 1987. The story was almost identical. The market had once again entered a period of irrational exuberance. Stock prices were reaching new highs, valuations were stretched, and investors were piling into the market. By 1987, the Dow Jones had risen from just over 1,000 points in 1982 to more than 2,400 points by August. The market had grown by 140% in just 5 years. The economy seemed unstoppable. People were confident. The news headlines were filled with stories of the market's strength, and no one could fathom the possibility of a crash. But Paul Tudor Jones, a hedge fund manager, wasn't so sure. Jones had already made a name for himself as a skilled investor with a keen sense of market movements. His ability to read the market and anticipate price movements had earned him both respect and wealth. But by 1987, he could see the warning signs. The market was overheated, and the rise of program trading, where computers executed massive trades automatically, was starting to create instability. Just like Kennedy in 1929, Jones felt a sense of unease. He could see the same dangerous patterns forming. Valuations were too high, and risk was becoming more and more pronounced. Jones didn't waste time. He began raising cash, reducing his exposure to the stock market. Like Kennedy, he understood that a crash was inevitable. He made the same move Kennedy had made decades earlier. He bought gold. Gold would act as a hedge, preserving his wealth when the inevitable crash struck. But there was one other trade Jones made that set him apart. He positioned himself for volatility. Jones knew that when the market crashed, volatility would spike, and if he could position himself correctly, he could profit from that volatility. October 19, 1987 came, and with it, the market's collapse. The Dow Jones plummeted by 22.6% in a single day, the largest single-day percentage drop in U.S. history. The world watched in shock as the market tumbled, but Jones wasn't panicking. He had positioned himself perfectly with cash, reserves, gold holdings, and volatility bets in place. As the market fell, Jones's volatility positions exploded in value, and he made $100 million that day alone. Jones's hedge fund finished October up 62%, a staggering performance in a month that saw most investors lose everything. Jones had executed the same 3 trades that Kennedy had made in 1929, and the result was the same: success in the midst of chaos. In 2008, the world faced another financial collapse, but this time, the story was different. This time, the collapse wasn't triggered by stock market speculation. It was caused by the housing bubble. The housing market had been inflated by risky subprime mortgages, and banks had become far too complacent, lending money to borrowers who had little chance of paying it back. The market, once again, was at the edge of collapse. Michael Burry, a hedge fund manager, was one of the few who saw the collapse coming. Burry had spent years studying the housing market, and by 2005 he had come to a terrifying conclusion. The subprime mortgage market was a ticking time bomb. In 2006, he made the decision to shift his entire fund into cash and make one of the most controversial trades of his career. He bought credit default swaps, essentially betting against the housing market. The trade was bold and risky, and his investors were furious. They didn't understand what he was doing, but Burry understood the math, and he understood the pattern. As the housing market began to unravel in 2007, Burry's bet paid off. The financial system was on the brink of collapse, and Burry's fund made over $700 million by betting against the mortgage-backed securities that were tied to subprime mortgages. Just like Kennedy and Jones before him, Burry had seen the warning signs and had positioned himself for the crash. At the same time, John Paulson, another hedge fund manager, was making a similar move. Paulson saw the housing bubble for what it was, a massive fraud waiting to collapse. He, too, bought credit default swaps and bet billions of dollars against the housing market. When the market collapsed, Paulson made $15 billion, cementing his place as one of the most successful hedge fund managers of all time. Warren Buffett, the Oracle of Omaha, also saw the collapse coming. Buffett had always been known for his cautious, conservative approach to investing, but by 2007, even he couldn't ignore the warning signs. Like the others, Buffett raised cash, and by 2007, his cash reserves had ballooned from $40 billion to $60 billion. As the market crashed, Buffett took advantage of the opportunity, investing $5 billion into Goldman Sachs at the absolute bottom of the market. His bet paid off, and by 2010, that $5 billion had grown into more than $10 billion. And now, in 2025, the pattern is repeating itself. The market is once again riding high, fueled by unsustainable valuations, excessive leverage, and euphoria. The signs are all too familiar. The smart money is pulling out. Warren Buffett is sitting on a record $325 billion in cash. Jeff Bezos has sold over $13 billion in Amazon stock, and Mark Zuckerberg is liquidating his Meta shares. Jamie Dimon has even sold stock for the first time during his tenure as CEO. The pattern is eerily familiar, but what about you? Are you prepared? Just like Kennedy, Jones, Burry, and Paulson, the smart money is executing three simple but powerful trades: cash, gold, and volatility. These trades have worked in every major market collapse in the last century, and they will work again. The question is, will you recognize the signs and position yourself accordingly? Or will you ignore the pattern and risk losing everything when the crash comes? The choice is yours. The crash is coming. The pattern is repeating itself. The smart money is already in cash, buying gold, and betting on volatility. Will you follow their lead, or will you be left holding the bag when the storm hits?